Hi, everyone. I'm pretty much sure that you have heard these terms or maybe researched on these terms. Terms like unicorn companies, startups, etc. So, in this video, we'll be discussing something regarding that. The question regarding what does an investor look into these startups before investing into them? Now, this question is very interesting. I mean, like, what are the aspects, what are the areas these investors are actually looking before making, such big investments? Now, to be very honest, there are no principles, there are no rules, there are no, laws or anything like that, because it totally depends on an investor, because it is the ultimate decision or a plan or a strategy of an investor. Now, the first aspect that an investor could take into consideration is regarding the number of investors altogether in the startup. Now, why I said this is because initially in a startup, the initial days or initial years of a startup, the founders are in desperate need of money. So, due to which what happens is founders tend to accept or take in multiple number of investors at once. So this creates a mess, and smart investors would definitely opt out when they get to know that there are multiple investors, because this raises a question of management. Who is going to manage so many people altogether, right? So smart investors would opt out. Second aspect would be regarding experience. If the founders have less experience, even though the startup idea is amazing, top level startup idea, profitable, and the founders have the potential to utilize all the resources, even though the question comes down to the experience of the founders. Now, in certain cases, if the investors are happy to help or mentor these founders, it totally depends on the founders if they want investors to intervene in their function or in their roles. It totally depends on the attitude or the right mindset of a founder in such case. The third aspect would be regarding the investors' money, investors' investment, because obviously an investor wants his investment to be protected, right? So in such instances, what the investors usually tend to do is they get into an agreement with the founders, and they negotiate and make sure that certain clauses are watertight clauses like right of first refusal or right of first exit. Such clauses are made watertight in order to ensure to protect the investors' money. The next aspect regarding this could be valuation of a startup. Now, in the initial years of a startup, it is very difficult to determine or calculate the valuation of these startups. Now, when it is difficult to calculate the valuation part, then what founders usually do is they offer these investors with convertible shares. Now, convertible shares is an amazing option for the investors in return of the investment that they're providing the founders. The last aspect could be regarding the management control. Now, certain investors, they want a direct right regarding how the startup is functioning. They want an advisory share, or maybe they want a right. They want a board seat to become a part of the board of directors to see or to observe how the startup is functioning. So these are certain areas where investors could take into consideration. They could see how this organization is working, and then they can as per these aspects, or there are maybe more aspects, it depends person to person, then they can finally make a decision whether to invest or not. I hope you like this video. Thank you so much.